Green Rush, Mining the Energy Revolution with Matt Watson.
Hello and welcome to Green Rush, Mining the Energy Revolution. I'm your host, Matt Watson. This week we're going to talk about PGM mining, and we have the primary stakeholder in the South African Waterberg PGM Project, Mr. Frank Hallam. He's the CEO of PGM Ltd. Frank, welcome to the program.
Hi, Matt. Thanks for having me.
Well, first of all, let's get into a little bit about, your organization. Who is PGM Limited? And you go to your website and you see this. There's three major buckets. You have information on the Waterberg project, which we will focus on today. You have information on a project called the Lion Battery Project, which we'll cover, I believe, in 3 weeks from now with the professor from Florida University on this. And then a section on investment in general. Again, we're going to focus for today on the Waterberg project. So let's get into that. And so why don't you just tell us, give us some broad overview of the Waterberg project. What is it? Where is it? And why does it matter?
Sure. So Platinum Group Metals Ltd. Has been working in South Africa since about 2003. So we've been here a long time. We've built and operated a mine. We've done a lot of exploration. We discovered the Waterberg deposit on first principles. We put together a new business group and did a lot of study and investigation back in 07, 08. We staked the territory in 2010, and did the work and made the discovery in 2011. The Waterberg deposit is located on the north end of the north limb of the Bushveld Igneous Complex in South Africa. So the Bushveld Complex is the world's largest layered intrusion, and it's the largest repository of platinum group metals. Most of that is in what are known as the Merensky and the UG2 reef. So those account for about 45% of world PGM production. Those are narrow deposits. They're typically 1 to 2 meters thick. Most mining is done around 1.2 to 1.5 meters thick. Right. Most of those are getting older and deeper. Waterberg is different because it's bulk. It's only 140 meters vertical in depth, so it's shallow and it's thick. The F zone is over 100 meters thick in places. So the north limb is
Frank, I was going to ask you about that. So the eastern and western limb, I think, are notorious for being anywhere from a mile deep to even further, right? Some of these reefs are, especially UG2, are extremely deep. And the northern limb, the benefit of the northern limb in general is that all these deposits are shallower. And the Waterberg in particular, you're at the very northern tip of this. It's at basically the shallowest point of the northern limb. Is that right?
Yeah, almost. The Merensky and UG2 are getting deep. Some of the mines are, 1,500 meters and 2 kilometers deep. Most of the mining is probably in the 500 meter to 1,000 meter range, but because it's narrow, it's expensive and it's dangerous. It's very labor intensive with those narrow reefs. Up to the north, you're exactly right. That's where the bulk deposits are found. The Mogalakwena mine, open pit for Anglo-American platinum, Ivanhoe's Platreef project. These are thick deposits. They're all Bushveld. They're all age dated at about 2.05 billion years old. They're all the same event, as it were. The Waterberg deposit is located under sedimentary cover at the north end of the north limb. So we found it on first principles. We did geophysics, we did some airborne work, we studied available maps, and we then went and did some drilling, and we made the discovery in 2011. Basically, third hole made the discovery, and the rest is history, as they say. The deposit starts at about 140 meters vertical. It's dipping at about 38 degrees to the west, but it's thick. The F zone is over 100 meters thick in places. So when you combine that shallow depth with that kind of thickness, it gets to be pretty interesting from a bulk mining perspective, particularly compared to the narrow reef conventional mining of the Merensky and UG2 reef.
Right. And typically the size of that ore body is typically just meters deep, right?
The UG2 and the Merensky are typically just a couple of meters thick. The average mining thickness in the Merensky, for example, is between about 1.2 and 1.5 meters
Wow.
of thickness. So it's dramatically different.
So this represents quite a lot of material, and obviously will influence the cost structure dramatically as a result of that.
Yeah. Exactly. We use bulk mechanized methods, long hole open stoping. We're using, multiple head jumbos and remote mucking conveyors. I mean, the productivity by worker is dramatically different. Annually, we'll be producing about 240 ounces per worker, versus, 20, 30, 40 per worker for some of these other operations. So it's a dramatic difference in productivity. And of course, that's how you get the cost down.
Absolutely. Fantastic. Okay. And yeah, here's a little bit more, I think, on that very same subject.
Yeah, this is a great slide. The little panel on the right shows you a 40-meter stope in Waterberg. So that's like a 13-story building. And
Wow.
then you can see the little guy standing there. He's at just less than 2 meters of height. And then a 1.2 meter thick mining cut in the Merensky Reef. So that's completely different. In these breasting panels for the Merensky, the guys are going in with jack legs on their hands and knees, breaking and scraping out the ore. It's very labor intensive, and it's dangerous, and it's uncomfortable. By comparison, at Waterberg, you're in climate controlled equipment, working under supported ground and using conveyors to move the material out of the mine. So it's a much different environment. It's a safer environment, and it's highly efficient.
Standing. So talk a little bit about the ownership of this project. I was surprised when I saw this data. I knew you guys were the primary stakeholders, but go ahead and walk us through the ownership.
Sure. Yeah. So the concentric rings there are showing the direct interest and the indirect interest. So we own a 37.19% direct interest at the project level. Our empowerment partner, Mnombo Wetu, owns 26%.
Right.
We own just less than half of them, which is allowed under the laws and the charter here in South Africa. We own just under 50% of them, which gives us another effective 12.97% indirect interest. So when you add that together, you middle ring, you see we have a 50.16% controlling direct and indirect interest in the project. You then look at the Japanese HJ Platinum. That's an aggregation of the Japan Organization for Metals and Energy Security, or JOGMEC, and Hanwha Co., a diversified trading company out of Tokyo. So JOGMEC's purpose in the world is to go around and look for new deposits, to spend money on exploration, and then secure development to bring those resources back to Japan. So they've been involved with us since the beginning at Waterberg, and they've been a great partner. And then, of course, you have Impala Platinum. They bought a 15% interest in the project in late 2017 for US $30 million.
Right. Fantastic. So, again, I think painting a broad strokes of, the amount of material that you're talking about is astonishing. 23 million ounces of PGMs. That's pretty substantial.
Yeah. I mean, that's the proven and probable. If you go to the resource in all categories, it's over 40 million ounces. And it's just a result of drilling. We've spent $89 million US to date, most of that on drilling and engineering. There's almost 375,000 meters of drilling, 484 mother holes, 585 deflections. So, and you could make this as big as you want. The mine plan currently covers about 8.5 kilometers of strike. The resource covers about 13 kilometers of strike. And we actually then have another step out hole, another 10 kilometers farther away than that, where we've hit the T-zone again. So, this isn't just a mine, it's a district. And it's quite remarkable. At depth, we've cut the deposit off arbitrarily at 1,250 meters vertical. We have boreholes deeper than 1,800 meters. So it's open at depth, it's open on strike, and it can get almost as big as you want.
Right.
Just in looking at this slide here, it's an important slide, the commodity split. We call it the PRIL split.
Right.
So looking at the four elements, platinum, palladium, rhodium, gold, you can see the numbers there. Over 63% palladium, almost 29% platinum, 1.5% rhodium, and 6.2% gold. And there's quite a healthy copper nickel credit as well. It's just under 0.1 in copper in the deposit and around 0.18 in nickel. So you get quite a healthy kick. It's almost 20% of revenue at the base case, and the feasibility study comes from the base metal. So they're significant. But the thing to point out here is the palladium versus platinum discussion. You know, platinum and palladium have different outlooks. Platinum is seen as being very strong going forward because of its use not only in auto catalysts, but also in the hydrogen economy. It's used in hydrolyzers and in fuel cells and various other applications. So platinum has a fairly strong outlook looking forward.
Right.
Palladium's been a bit more doubtful because it's primarily used in auto catalysts. The penetration of battery electric vehicles into the marketplace is seen as taking away demand for palladium. But when we look at our revenue and model it out, you know, if you lose a bit on palladium, you gain it on platinum. Rhodium and gold are strong, and of course, copper and nickel are always going to be needed. So it's a basket. And in almost all scenarios that we model, we end up with very strong revenue from this basket.
Right. I was going to articulate that. So, you know, when you get to the eastern and western limb, you know, the platinum is the dominant element, with palladium following, typically at a 2-to-1 ratio. Here it's flip-flopped.
Yep.
But with, I think, a higher rate of gold than you see in the others, with these other sundry copper and nickel. Any PGM miners? What about iridium and ruthenium?
There are minor amounts of ruthenium and iridium. We don't believe that they'll reach payable levels in the concentrate, so we're not modeling any revenue from them.
Okay, but there is a potential opportunity that you could harvest if
there is.
Yes. Okay. Good. Fantastic. Yeah, and again, just to emphasize for our listeners, and we've talked about this in previous episodes, you know, palladium, over 85% of the palladium goes into catalytic converters. Only about a third of the platinum goes into catalytic converters. Platinum is a much more diverse set of demands, including jewelry, medical, on and on and on. Just a whole list of different catalyst functions. Rhodium, again, very, very focused like palladium on catalytic converters. Although I have lots of hope for rhodium use downstream, you know, post-ICE vehicles. It's an excellent catalyst with a lot of great functionality around NOx reduction. So really, I think you're right. Focusing on palladium and next generation palladium uses is essential, not just for this Waterberg project, but for the PGM basket globally as a whole. And I think the industry is aware of that. And that's what the Lion project that we're going to talk about in a couple of weeks is all about, is helping to generate these next generation palladium demands. So if you could really see a more positive outlook for palladium, then yes, I think this whole project just becomes an absolute slam dunk, right? Am I reading this wrong?
No, you've got it. But you know, the thing that really makes the project work is the costs, because the bulk mining allows such a low cost. When you model this out, the project comes out at the low end of the cost curve, one of the lower, or you know, amongst the lowest cost PGM mines in Southern Africa. So even if you have a weaker outlook for palladium, as I said before, the basket gives you strong revenue, but the low costs really, you know, put you in the game. So, you know, even at a 20% lower metal price than we just published in our DFS update, our 4E basket price in the update was $13.25 US. Even at 20% below that, you still have a 40% margin. So it's the combination of costs with a diversified basket that makes the project work. And if you have a stronger outlook for palladium than everybody currently expects, it just gets better.
Right. By the way, your gold price assumption was extremely low now that it's at 2,600 and change.
Yeah, so, our gold price assumption was a little over $1,800. Yeah.
Right. So you have a lot of extra margin that's going to come there as well. I thought this next chart was fascinating. Even as an analyst, you know, I hadn't put it in this context, but you just show simply these three primary elements used in catalytic converters: the platinum, the palladium, and the rhodium. You show the demand trajectory over the past couple of years, just to give people a sense of, hey, this demand hasn't completely eroded away. And the key to that, and I think you highlighted correctly, is it's hybrids. It's the growth in hybrids and hybridization. And really the big forward-looking question is, well, how much of the vehicle mix is going to be hybrids going forward? And for those who don't know, again, for previous episodes, we've talked about this. Hybrids, the loadings of these PGMs in the catalytic converter that goes into a hybrid vehicle, like a Toyota Prius, is typically about 10% higher than a conventional ICE vehicle. They actually have to put in even more PGMs. And the reason for that is cold starts is the most strenuous point for emissions. When you cold start your vehicle in the driveway in the morning, that's when you have the highest emission spikes. The only thing worse than starting it cold is to be using electric in a hybrid vehicle for, get on the freeway going 55 miles an hour and then have the engine engage. That generates even bigger transient spikes. And because of that, automakers have been forced to actually increase loadings in the hybrid. So every time you see a part of the pie going to hybrids, it's actually pulling the PGM demands up. And that's really playing a balancing act in terms of detriment from ICE, from the BEV erosion, from the Tesla type of erosion. Am I reading that right?
Yeah, no, you've got it, Matt. And what's really fascinating is, until recently, that distinction wasn't being made. So a lot of reports and studies were showing hybrids included with battery electric vehicles, and that subtlety was lost. And of course, it's an important difference. And it's really interesting to see in this chart. This chart is put together by SFA Oxford. They're recognized experts in this space. And you can see that battery electric vehicles are really been plateauing in the last year or two, and the sort of enthusiastic expectations of market penetration are becoming somewhat more subdued. And when you combine that with the hybridization, as you've mentioned, and even just general growth, I mean, the world population is growing, and there's new economies around the world. People want vehicles, and a lot of them are going to go to internal combustion engines for some time. So the outlook is becoming a bit more stabilized, and it's not as negative as it was. So the outlook for palladium is actually improving in recent months.
There's all sorts of news reports, especially in Europe, of declines in the BEV penetration rates. Again, hybridization is taking off. It is the preferred configuration. It's when you go to purchase a vehicle, you don't need a subsidy for those hybrids. And they're selling like hotcakes for all the obvious reasons. You get better gas mileage. You do impact emissions dramatically with hybrids. To me, I see a state where through 2040, easily, the hybrid mix should be much larger than the BEV mix for decades to come. I think still, and I think your message is right here that don't give up hope on the catalytic converter demands. It's going to be there for some time.
Exactly.
Well, you had a number of slides. For sake of time, I don't know how much we wanted to get into it, but you described the ore body and all the various drill holes that you've done. High level picture here. Anything you want to bring up that's significant?
Yeah, this is a great slide. So this is a long section. Imagine that you're standing in the west, looking to the east. So the ore body, the T-zone and the F-zone, they're dipping towards you at about 38 degrees. You can see in the little circle there at top left, that's a cross section showing you what it looks like. There's actually about 300 meters of middling between the two zones. The T-zone is the brown and red colors. The F-zone is the thicker zone in the blues and greens. That panel is covering about 8.5 kilometers, and that's in the mine plan. And those vertical black lines are the boreholes I spoke about. Interestingly, the T-zone is not drilled off on strike as far as the F-zone where the mining is going to begin. And if you look at that plan at the bottom, there's a little square there that's showing you the up-dip edge of the T-zone and the F-zone. So the eastern edge of those colors is where the subcrop is. So you have the sandstone sitting on top of it. And it may be a little hard to see for everyone on your screen, but in the top left of that panel, you can see the topography. That's the Mohabeng Plateau. And that's several hundred meters of thicker, more weather-resistant sandstone that's sitting on top of the deposit. And it forms a cliff face that goes right along the edge of the T-zone subcrop. So you can't get the drill rigs along that cliff face to drill. We did put one hole up over the top on the Machabeng, and we did hit T-zone. And we did go to the other side of the Machabeng plateau, and we hit it again way off on the strike extension. So what that's telling you is that the T-zone is there. And when we get underground in the F zone, we will put in some drill cubbies and drill off more T zone. We expect to have a lot more T in the future as we move forward with mining.
Wow. Okay. I got it. Okay. So yeah, this is a sizable deposit. You're giving me a good impression of the scope of this thing compared to most of these mines. This is substantial. So you just completed your latest DFS update. Why don't you give us the highlights here?
Sure. Yeah, there's some important differences. We did do a feasibility study in 2019, which was quite positive. It was a great study. Looking forward, we have made some changes to refine and improve the mine plan and the study and the outcome. Most importantly, in that central F zone that we've been talking about, it's so thick. There's so much material there. After discussion with our partners, we reduced the cutoff grade in that zone from 2.5 grams to 2 grams. And what that did was dramatically increase the tons per vertical meter and allowed us to really reduce the amount of development and improve the amount of ore that we could bring out. So suddenly we've got enough ore and capability in that zone that we can get 400,000 tons a month out from that zone alone. So one set of twin decline infrastructure. So that would meet our nameplate throughput for the mill. And when you do that, you can then defer the infrastructure into the T-zone. So in the original study, we had a second set of twin declines into the T-zone. By eliminating that, we reduced the capital by about 200 million US, and we can still develop into the T. We do in the mine plan about 20 years, 25 years down the mine life. We develop from underground into the T-zone. The T-zone's higher grade and higher gold content, so you really want to get there. You could do that sooner, so we can change and develop into it sooner if we wish to. But the way we've modeled it really reduces the capital and optimizes the output. And the other important things like water, we'll be collecting our water from ground sources. We've reduced the amount of water consumption by almost 40%. By using dry stack tailings technology. I mean, that's great from an operating point of view. It does add some capital to the plan, but it reduces the strain on the underground water supplies and gives us more buffer in our water balance. So that was a really important improvement going forward as well. And then, there's lots of other minor refinements. We and our partners have done a lot of work on optimizing and risk mitigation. Geotechnical things, the way the ventilation is laid out, the way the sublevels are laid out. We're working with just 20-meter sublevels for the first several years of mining during the ramp up. We do go to 40-meter sublevels and stoping in the future. But in order to build up the skills with our crews, we start with just 20. So things like that. But the big improvement is the reduction in capital and the real optimization and simplification of mining one zone, one set of declines in the central F during the ramp up in the first 20 or 25 years of mine life.
Understood. Well, so before we get back into our content, I want to take a moment to thank our sponsor, Revival Gold. Pay attention for the next 30 seconds to hear what Revival Gold is all about.
Revival Gold, ticker RVG on the TSXV and RVLGF on the OTCQX market, is one of the largest pure gold mine developers in the United States. The company is advancing engineering and economic studies on the Merkur Gold Project in Utah and mine permitting preparations and ongoing exploration at the Bear Track Arnett Gold Project located in Idaho. The company is financed and currently focused on the completion of a preliminary economic study on heap leach gold resources at Merkur and continued exploration along 5 kilometers of underexplored structure at the company's multi-million-ounce orogenic gold system at Bear Track Arnett. For more information, please visit www.revival-gold.com.
Before we dive back into our content, I want to take a moment to thank our sponsors, Revival Gold. And it's because of them that we're able to bring this great content to you. So thank you for that. So let's get back into it. And Frank, you had a really nice summary slide here on some of the advantages. You talk about the thickness and grade. You talk about the average deposit depths. You talk about the 4E ounces per worker. And most importantly, what this all leads to is, of course, that PGM cost curve and where you sit. And I think this is really the telling discussion here at the end. Why don't you walk us through this?
Sure. Yeah, this is a great slide, a lot of content, but we'll try to go through it. So top left, we're just looking at thickness and grade versus some of the other operations in the industry. So you can see the T-zone there with an average stope thickness of about 7.5 meters, and it has great grade at 4.47 grams per ton. Looking at the F zone, we're just showing 140 meter stope. The reserve grade or the head grade there is 2.96 grams per ton. So a little bit lower grade, but because of the bulk nature of it, it really offsets that grade and gives you great efficiency and lower costs. It's interesting, the ore to waste ratio in that zone, for example, is over 14 to 1. So that's pretty impressive. And you compare that to the rest of the industry, you can see the Platreef project there at about a 19.5 meter stope and great grade at over 4 grams. So it's up on the North Limb with us. That's a great mine as well. But then you go to the other mines, the UG2 and the Merensky mines that we spoke about in the Western Limb and the Eastern Limb. And you can see they've got good grade, but boy, oh boy, look at those thicknesses. There's no comparison. And so that's the difference in terms of productivity. And to point that out, you can look at the 4E ounce production per worker on the next panel below, bottom left. And you can see, as I was saying, that big, thick red bar is Mogalakwena at over 300 ounces per worker per year, and then Waterberg at around 240. And then everybody else falls away from there. So that productivity translates into cost. And then going over top right, you can see the depth there. We've placed the average depth of Waterberg at about 500 meters vertical. And you can see as you go towards the right there, boy, some of those projects get deep down to over 2 kilometers, as we spoke about before. You know, those projects, they get challenged at almost any price. At some point, you reach depths where it's just not possible to continue. So, you know, there's going to be closures over time, and in a lower price of metal environment, they become even more likely to see closures. And I think we'll hear more about that in the months and years ahead, depending on where the market goes on pricing. And then finally, bottom right is the cost curve. That cost curve was assembled by SFA Oxford, the people we spoke about before. And it's just looking at cash cost and stay in business capital and then plotting where everybody shows up. And you can see, as we've discussed, Waterberg shows up, you know, right at the far left, almost at the farthest you can get. I mean, it's right in the lowest cost quartile. And so if you're going to be in a low cost environment, maybe that's what we're going to be in for a while. That's where you want to be on the cost curve. So that's why this project works.
Fantastic. I just want to highlight the Platreef project is not off the ground yet. It's not in operation. It's still in development mode as well. So
the phase ones, yep.
But to your point, I mean, again, another Northern Limb project like yours, a little bit further south in that Northern Limb. But I wanted to focus on this for a minute. So here's your cost outlook below $1,000 per troy ounce for 4E. I want to jump here. I put together some actual data on the basket, the PGM basket, if you will, and basically just the troy ounces mined times the average price for the year over time. And you know, we've been through an interval here recently in 2021 where the price of rhodium and palladium skyrocketed, and so as a result, PGMs as a global basket, if you will, climbed to nearly $60 billion in value, and is now on a decline. So we're in a tightening mode, kind of back to a typical baseline of where we were at previously. And one of the things I wanted to point out is if you calculate the average, and I'm using a true PGM 6E, no gold, dollars per troy ounce, the basket price, we're still sitting here at about $1,100 per troy ounce, and I think it's going to hit bottom, and I think we'll see it start to increase, especially with platinum and some of these other metals starting to climb. That $1,000 mark is really important, I think, long term to stay cost effective, and here you are well below that. I think that that bodes well even in a worst case scenario for PGM prices. I think that buys you some robustness, and again, I think the long term outlook for platinum and some of the PGM basket is going to be starting to climb and become quite high. So I think that bodes well for you. Your thoughts?
Yeah, and that's what I was saying before, Matt, was you want to be on that end of the cost curve. And so, that's what gives you some cushion against the negative impact of low prices when those prices occur. Our 4E basket price in consensus prices of the DFS update just published is 1,325 US per 4E ounce.
Right.
If you take even a 20% reduction in that basket price, we still end up making a 40% margin. So
exactly.
That demonstrates the robust nature of the project.
And the nature of mining, of course, the guys at the high end of the cost curves, those are the ones that are going to be forced to contract, right? Mining, the response time on mining, unfortunately, it's a very slow whip to respond to the changes in market conditions. There's still contraction going on in the market, as you know. Sibanye questioning, it's Montana. They're going to cut their output in Montana in half because of these costs. But I think there's others that are in similar cost pressure. And so as that market contracts in terms of production, of course, that's going to boost the basket price as well. So
we're already seeing some supply come offline and being scheduled to come offline. And the other really interesting thing is we're not seeing the recycling ounces come back to market that were anticipated. The World Platinum Investment Council has been speaking about that with us, and we're just not seeing the level of recycling of catalytic material that was expected. So, depending on where that goes in the years ahead, that could also be another source of supply that's been removed from market.
I think it all comes down to vehicle sales, and you look at vehicle sales, the aggregate, including BEVs, the whole amount of vehicles sold is reduced. Discretionary income and with the interest rates the way they are, people just can't afford the new vehicles, and they're hanging on to their vehicles longer. Is the key answer as to why that phenomenon is going on with recycle. I know I've been hanging on to two older cars with 250,000 miles on them. They're still productive. It's not worth going out and buying a new car. It's cheaper to keep those older cars and let the kids drive those.
Absolutely.
And I think that's the phenomenon driving the slowdown in the recycle. There's no reason to expect that it won't continue. I think that we're seeing all sorts of evidence that people will continue to hang on to their cars longer. In your investor slide deck, I jumped ahead here. You talked a lot about the nature of your ore body. It is different, right? It's going to be so much more concentrate than I think some of the other Eastern and Western Limb mining operations. I'm really interested in your direction on both concentrating and what you're going to do for the smelting and refining piece, because it's going to be a different value stream that could require a whole different process in a lot of regards. So walk us through how you think this is going to bear out in terms of development of a refining and smelting scheme.
Sure. Yeah, all of the projects on the North Limb, just based on their metallurgy and the nature of the flotation required to get recoveries, the mass pull, etc., they all produce a concentrate that has plus minus 80 grams per ton of PGM. So that's, kind of similar amongst all of them. Interestingly, they all have, depending on whether they're copper or nickel dominant, they all have fairly high base metals. Platreef for Ivanhoe has a lot of base metals. The interesting thing is they're all sulfide concentrates. And so they do go through the existing smelting facilities here in South Africa, relatively easily. Of course, Anglo American Platinum smelts and refines their own material from Mogalakwena. The issue in the smelting circuits here becomes the base metal refinery. And if there's going to be a bottleneck, that's where adjustments are needed. That's where you kind of plug up or bottle up the process here. But relatively speaking, the concentrate goes through the existing smelters. And because of the higher level of UG2 mining these days, which is a chromite or chromatite, there's becoming a paucity of sulfide concentrates. There's less Merensky, and you need a minimum, 30-40% of feed in your furnace, in your mat, in order to have lower operating temperatures and good recoveries. So that these concentrates are actually going to be more in demand. So we're in discussion with the existing smelter companies here in South Africa, working to try and get offtake. And we haven't succeeded to date, but we've got live discussions, and we're hopeful that something will come to pass. But as an alternative, we've also been looking at the possibility of sending the material for smelting and base metal refining in Saudi Arabia. And a lot of your viewers will know Saudi Arabia has an Investment 2030 program. They're looking to diversify their economy, and they do want to become a mineral processing hub. So they're offering significant incentives to bring this material to Saudi Arabia and have it processed there. So that's also something we're looking at. We entered a cooperation agreement with Ajlan and Brothers from Saudi Arabia in December of last year, and we're busy with that now. In order to do that, we would need an export authorization from the government of South Africa, and we and the Saudis are in discussions with the government about that. So you have to have a concentrate offtake agreement to sell your concentrate and get your revenue to finance the project. So it is a critical step, and it's going to be one of the next big things we need to get complete.
Right. Just crazy talk here, but why not a whole new smelting and refining operation for the Northern Limb, where you could tune it?
Well, Anglo American Platinum already has their own facility in Polokwane, and so they can basically deal with themselves. Right. Ivanhoe and ourselves could partner up and build a facility. We've talked about that, but it hasn't taken off, so we're not doing anything right now. But we've talked about it. But it really becomes an allocation of capital question. A new facility of size to deal with the amount of material we're talking about, is probably $500 million US. And then there's the question of power and water and permitting and all of that sort of thing. There probably is enough power and water here, and certainly the government of South Africa and Eskom says there is. Investors are a bit more uncertain about that, and so when we've talked to people about that possibility, there's enthusiasm for the idea, but concern about the power situation. So it's interesting, but it's not probably the first thing that's going to occur. It's more likely that we'll get an offtake agreement or go to Saudi Arabia, in my opinion.
Right. Yep. And the Saudis are dead bank serious, and they have lots of cash, so they're motivated, right?
Yep.
Absolutely motivated. Fantastic. Well, that was a good overview. So give us all a sense now of timing and where we sit with this. So you had this nice timeline in there.
Sure. Yeah, well, we've got our mining right. We've been working on construction readiness, and our DFS update is just completed. So, if we were to take a construction decision tomorrow, put a shovel in the ground, you start developing your declines and your underground development. That's really the critical path. You've got 4 or 5 years of development to really get yourself into the underground, building the mill and the flotation circuit, et cetera. That's about 24 months. So if we started tomorrow, it would be about 3.5 years to first ore production. It would be about 4.5 years to the plant being commissioned and first concentrate. And from there, you would ramp up. So it would take you roughly from the time you start till full production, about 7 years plus minus to get into full steady state.
That's actually quite fast compared to other projects. So that's outstanding. Well, good. So Frank, any other closing thoughts about this project and what needs to occur next?
Yeah, well, the concentrate offtake is the next big step. In the meantime, we're considering, what our path forward would be. We'll consider it with our shareholders and our JV partners. We could do more construction readiness, power, water, roads. We're considering a bulk sample. A good interim step might be to put the twin declines and the first sublevel development in place and begin running material through a pilot plant to refine and improve your metallurgical recoveries, et cetera. And it also cuts into the time for development because you're doing work that you need to do anyway. So that might be a good interim step. And depending on whether we get the offtake or not, if we do, then we can start looking at full financing and construction. So it's going to be an interesting sort of 3 to 6 month period here while we work on all these things.
Fantastic. Well, Frank, I can't thank you enough. I really appreciate this overview. As you know, I'm a PGM guy at heart and very concerned about the future of PGMs. We're we're going to see some of these older mines time out and reach into life. And the question is going to quickly become, where are we going to get our PGMs from next? And certainly this is one of the most sizable and meaningful projects on deck. So wish you all the best, sir.
Totally agree. Thank you, Matt. Yeah, I think the future of the South African business is going to move to the North Limb. So our day will come.
I think you're right. Again, this is Green Rush, Mining the Energy Revolution with Matt Watson, your host. So join us next week as we take on another couple of elements on the periodic table, and we look at these elements as they impact our clean energy transition plans, folks. Looking forward to seeing you next time. Thank you. Take care.
Green Rush, Mining the Energy Revolution with Matt Watson.